And we are live on. We bring the big names. We have the big fun. We've got Jonathan P, JP, Jonathan Preston. How you going, mates? How's your day?
Very well, thanks, mate. And yourself?
Yeah. Look, I had the day off today. Just chilling out, mate. Go down in Milton, Ulladulla, and look, it's amazing. How, I know it is. I know it is summer holidays, but yeah, it's just amazing. Like driving through Milton, I haven't been down that way for probably 10, 15 years, so it's crazy the amount of people and just the property. And I drove through sort of parts of Shell Harbour today as well. And I saw there's properties 2.5 million, 2.3 million. I'm just like, whoa, like this is just insane. But anyway, how about you, Joe, mate? You've been jet setting a little bit maybe as well. You've been getting out and about, that sort of.
Oh, absolutely, mate. I was in Victoria last week. I was in Adelaide yesterday, and I'm now in Queensland. In a regional location in the Queensland lovely area, and it's beautiful here. A Queenslander home, they're worthwhile. I'm super excited for this one, JP. Though. Oh. What do you, Jonathan, JP? What do you prefer?
JP, because it's catchy, right? I don't know. Do you actually? Yeah. Catchy. So I didn't actually. I realised I didn't write a bit of an intro, but I kind of know your backstory anyway. So I kind of don't even really need I just can. We did work together, but let's smash this session. So I want to get into the quote of the week. So, Mr. JP, what is your quote? It's short and sweet. I know it already. But...
It's never too late.
Yeah. Well, geez. That's it. Mic drop. Interview done. We don't need it. So we want to see the comments, the questions, everybody, because this one's going to be big. It's going to be somebody unpacking their journey. We want all these good things. So throw your comments and questions.
Yeah, well, that's why I'm excited about this one, because this is how this property investment group started, right? We were just interviewing friends. We were just calling friends up and saying, "Hey, how's it going? What's your property journey like? Blah, blah, blah." And then it just started to grow. And we're like, well, why don't we just put that on Facebook and get other people to comment and stuff like that? So we're going back to our roots here. We have experts on as well, but we also have a little mini, investors.
JP is an expert. Let's not. He is an expert. This guy's done.
He is an expert.
400 podcasts. Yeah. You will see throughout this podcast. So Joe, what is your quote of the week, man?
Oh, what is my quote of the week? My quote of the week is, "The greatest danger occurs at the moment of victory." Now, that's done by Mr. Napoleon Bonaparte. So I guess that's kind of just around, don't get too sloppy on your due diligence. You see a great opportunity or you see something that's not a great opportunity and you move on it because you're getting FOMO, you're getting fear of missing out. It's just don't trip up at that last hurdle. The greatest danger occurs at the moment of victory. But that's my little life.
You actually wrote a different one, but yeah, that's one you did from a couple of weeks ago. But I'll allow you to rehash one. You had a Tony Robbins quote in there, but
oh yeah, where is it? Oh, there you go. Excuse me.
That's all right.
What about you, Jeff? What is yours?
Mine is if you look at this is Oprah Winfrey, and Oprah is just such a fan. She's, for me, an inspiring kind of just her backstory. If you ever think you're having go and have a look at what Oprah's done. But if you look at what you have in life, you always have more. So if you look at what you don't have in life, you'll never have enough. So it's kind of around that kind of being grateful for where you are and kind of just saying, okay, look, I might want 100K passive income or whatever it is. I may not have that now, but if you focus on not having that, you just actually miss that you've got all these great things around you at the moment as well. So that's kind of hits home for me, because I think we all get a bit lost in the race. So that's for me.
Yeah, there you go. Wise Jeff. That's what we're going to call you. That's your new nickname.
Wise Oprah.
Happy days. Good morning. Good evening, everyone. So, okay, well, let's jump into our sponsor of the week, Mr. Policey.
Commercial property offers the highest cash flow in Australian property investing, offering exceptionally higher yields than residential. Now, we're talking 8 to 10% net yields. That's cash after all expenses, not this 2 to 6% gross that we see in the residential space. So for those that are starting out on their commercial investing journey, it can be exciting, but it's also a step not to be taken lightly. The expertise of a commercial buyer's agent can pay dividends to help you secure that high cash flow and high growth potential property. And this is why we recommend Steve Polisi of Polisi Property. With over 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He has seen it all and knows the best locations right for growth. In a previous life, Steve was a chartered mechanical and structural engineer, so he draws on his mathematical and analytical skills that he's developed to break down what works best in commercial property. As with engineering, same goes with commercial property. It's based primarily on the numbers. So if you're curious about diversifying into commercial property, you have access to $100,000 in cash or in equity, book a call with Steve today and find that perfect asset for you.
Bringing back the ad from Chris Dusting. I love that kind of. It's still playing, but I saw in the comments I snuck a sneak peek. And JP Morgan, gee, that's somebody's compared you already. They're putting the big names and we bought JP Morgan back, so that leads quite nicely into who is the man, the myth, the JP legend in front of us at the moment. So he is you started off working in and correct me if I'm wrong. I'm just kind of ad-libbing here because I know each other. So you worked in finance for at least 10 years, I reckon, maybe even sort of 15 years. You seem far too young for that, and you kind of worked in various kind of roles, but you've been a broker for at least sort of 6-7 years. You've dealt with and you've built a multi-property portfolio. You're a property podcaster, over 400 episodes. So you've done that weekly. So you're the one of the best kept property secrets around. So, JP, a sneaky question we'd like to. I think not many people might know this about you, but what is one thing that people may not know about you that you can share with us?
Well, maybe not many people realize I'm actually from New Zealand originally, and
I knew that.
So yeah, I sort of grew up in New Zealand and adult life in Australia, and that gives me a bit of an interesting perspective too, because my parents were quite big property investors in New Zealand, and obviously there's a lot of dynamics there that are similar to here. So the Kiwi background.
Yeah, nice.
There you go. I hear it now. Yeah, I didn't hear it at all, but then you said it, and I'm like, oh, there it is. Okay, good.
Kia ora, Mr. Preston. So I was going to say you're also a big Red Devils Manchester United fan, which I love. I love that. I'm a big Red Devil. We used to chat soccer in the office as well, but I digress. So let's kind of unpack the first question we love to ask people is, tell us about your first property purchase, and this will kind of dovetail quite nicely into the rest of your journey, which is what we're going to be mostly talking about today.
Yeah, no, appreciate that. And I guess before I even mention the first purchase, I guess I want to talk about where I kind of stepped, like the first mistake I made. So I actually did seriously try and buy a property around 2010. And I was heart set that I wanted like a 1-bedroom. I wanted to be in the Waterloo, Alexandria. I wanted a garden style apartment, but I had a budget of like $450-ish. Now that could have worked, but at the time I sat down with the broker and he's like, you can't quite service that amount. And like, I wanted a long-term fixed. And I was so upset with the outcome that I was like, no, I'm not proceeding. And I got rid of him, and I didn't come back to like mortgages or borrowing for like 2 years. And that was one of the biggest mistakes I made. And that if I had started earlier and really listened to that advice and then, executed differently, that was a real lesson. So that's always the first thing I want to mention to people is when you start, don't stop and then sort of come back to it years later. Like when you start, keep going. But in terms of the next purchase, what I did was, a few years, I guess, has passed with that, and I sort of got over the idea that the first place I was going to buy was going to be owner-occ, and I resigned to the idea that, rent vesting was potentially a good pathway forward. I'd been sort of learning a bit about sort of Nathan Birch and stuff, and at the time I'd been going out with a girl who lived in the region of Liverpool, and I wasn't that familiar. I didn't grow up near there, but I did find the property prices were very attractive. I found that there was a lot of infrastructure. Obviously Liverpool train station and everything around there, it's very accessible Sydney-wise. And then obviously price-wise, compared to Sydney at a lot of Sydney at the time. It was very low. So first place was a 2-bedroom. From memory, I paid 217,000, and I almost didn't buy it over $3,000. We were fighting over 214 versus 217, and I still remember walking through the park one day. I was walking home from work, and I was thinking about it, and I was like, "Am I really going to let the opportunity to get my foot in the door for the first property pass me by over $3,000?" I was thinking $3,000, that's like 2 weeks in Bali, right? Like you forget about $3,000, but like if I misstep this, and so I called the agent back. I said, "Look, let's not nitpick, let's do it," and that was it. So yeah, 2-bedroom walk up in Liverpool. Rented it, I think, from $295 a week roughly initially from day dot, and 217 purchase price. So positively geared. Yeah, on IO, I believe it was positively geared from day one. Yeah.
Wow,
interesting.
I just wanted to go back and unpack that place in Alexandria Waterloo, because we've all been there. Even I was starting roughly at a similar time, and I sort of looked around 2011 and didn't buy in 2012, but then didn't buy to 2015. So I just kind of a similar kind of path to you. But tell us about, do you often look back at those kind of properties you're looking at and just say, "Well, crap, I've now almost doubled," or do you kind of look at that, or you just don't even torture yourself with that?
You mean like I should have bought more then, or I should have bought something?
Or you should have bought that sort of that place in Alexandria or Waterloo, the places that you're looking at.
Yeah, would it have been a better decision to have bought that one than waiting 2 years and then buying this type of asset? Because this deal sounds like it's bloody awesome anyway. But
yeah, I think the bit that, and look, I guess the lesson for me was I should have listened to the broker more. I should have been more open-minded. That was the bit, I came to him too close-minded. I was like, I want a long-term fixed rate because I think rates are going to go up. I was very specific about what I wanted. And when he came back and said no, I was sort of like, well, you're kind of letting me down. And so it's kind of like, I don't know, I didn't look at it the right way versus the right way is to listen to what can actually be done. And then, it might not be what you want to hear, but work with what you can actually do. Yeah.
There you go.
Were you a broker at that? Because you're a broker now. Were you a broker at that? Oh, well, I guess not. You would have been doing your own loan. Yeah. You weren't at that stage. But is that what kind of helped you?
Do your own loans, right, JP? That's kind of you kind of can't really. Yeah.
That's one of the good things about, I guess, one of the attractions to becoming a broker later was that I wanted to expand the portfolio. But no, at that time, I was working more in like the leveraged shares and that kind of speculative side of finance. And that was literally just like a CBA guy because I had my net banking or whatever with them. And so, I met that guy. And then it wasn't until I reached out, I think it was to like one of the Aussie home loans or one of those, that I actually met a guy who was really keen, really competent. And despite the fact that I only wanted to buy a $200,000 property, he really gave me the time of day, super attentive. And so he was, and that guy I ended up buying the first 4 properties through. And then the second guy did even more sort of magic, if you will, at the time. So those 2 guys did inspire me to, work toward being a broker later. Yeah.
Did they have their own property portfolios themselves?
Yes. So the first guy, I think it wasn't a huge portfolio. I think he had like his home and maybe 1 or 2 others. But, with him, he gave me such good service, treated me really gave me the time of day, despite that I never bought anything. And, so that really played a lot into it too. And you could tell he was a professional, and actually he still operates as a broker doing huge numbers, a lot of credit to him. And then the second guy I actually found on a property chat forum who was like a super expert talking about how to increase serviceability that other brokers couldn't do. So the second guy was even more of an expert, and that guy, he's a big self-made guy himself as well. So I was pretty lucky in terms of who I ran into.
So when you're choosing a broker, and I might be going on a tangent here, but is it a prerequisite or a requirement to look for a mortgage broker that has a property portfolio if you're trying to become a property investor yourself? Is that a requirement or a nice to have?
It's definitely ideal. And knowing what I know now, I guess, if you're in this space, it's easier to find the pros, online, you can easily find a lot of people who are big investors that also seem to know what they're talking about. So look, I'd say, if you know what you're doing, it's pretty much a requirement. If you're a newbie, if someone's going to give you, 100% time a day, dedicate everything to you, look, maybe that's still fine. But in the ideal world, you do want an investor. Yeah.
There you go. Yeah, I mean, yeah, that's great. Good question, Joe. Because often the kind of thing, it's whether it be accountant or all those. Are you going to somebody who's an investor themselves? So I think that lends itself quite nicely. So you bought 4. You're telling us you bought 4 properties. So kind of tell us about the progression. So you bought in the sort of Liverpool region, number 1. What did you, after you bought that? How did it feel? Like, what were the kind of what did you want to do next? Like, how did it all play out?
Yeah, so I guess one of the good things is I kind of remember the circumstances quite well. Like probably like a lot of people, I wasn't, I was relatively young, so I wasn't on that much money. I think I was only getting 50 grand a year at that time. And I think my full life savings was something like 70,000 or something like that from memory. I put down like 15% deposit. I don't know why. I ended up at 85%. I think I had a misunderstanding between the broker. Initially, if I had known, I would have done 90 or 95. But I don't know, maybe I don't know what happened. But anyway, we did the first loan at 85. As soon as it settled and I got like the tenant in straight away, first month's rent landed and I paid the first month's mortgage. And I was like, well, what was I worried about? Like this, it worked. And so I was like, well, let's do it again.
This
so I
is
called
easy.
him and I said, let's go again. And he said, what do you want to buy? And I said, look, let's go. And at that point, my risk profile changed because initially I was a bit scared about the areas. I wanted sort of like the infrastructure. I wanted something I felt really comfy in and, almost like that I could live in it one day if I had to kind of thing that people say. And so that was kind of with Liverpool. Once that settled though, I was like, right, let me find the pure investments. And that's when I started to think about Mount Druitt and stuff. Cause I was like, where can I get the real yields? Where can I look for a really emerging market that hasn't really boomed so much as yet? And so that's when I was like, right, that was easy. So let's go up a risk tier. Yeah.
Hey, one question I've got actually, you just going back to your history, because I don't really know you too well, Jeff. You and Jeff know each other quite well, but you were talking about you're in leveraged shares as an investment class. Why are you choosing property over a share? Like shares, leveraged shares, and you help people with them every day. Why is property the vehicle that you're using to generate your wealth instead of shares?
General advice, folks. We're not saying you should choose one or the other, but yeah, just wanted to put that out.
Exactly. Yeah. Got to have the disclaimer first, not a financial advisor, all that. I do have a bit of a diversified portfolio. The biggest challenge though is that, with non-property related assets, they're typically liquidatable. And so that's the issue with most people. And if you sort of study investing and stuff enough, like I've spent like 15 years going deep into investing theory and everything. So there's kind of a lot, I guess, that's
so
sort
liquidity. Why is that important? Like why would being able to get access to the cash quickly
basically like
return that you're going to get?
Well, what I mean is you don't want to be liquidated. Like, so basically you want to make sure that like if you have loans in property, they won't liquidate you if the market goes down, but in shares they will. Then they sell you out at the bottom, and then literally you never recover that wealth. So it's the liquidation is the issue. So these days I do hold some of the financial assets, and that's more to have a bit of a buffer. Like, let's say the rates go up hugely, or if I'm out of work for some reason or whatever for a while, then I've got something that I can sell off and draw down. But certainly the vast majority of my wealth is in property now, mainly because of that leverage. And I still do, invest in other stuff. But when I look at where the real wealth has been made in terms of my asset and liability position, it's been in property. And so I've increasingly focused in that space, basically. Yeah.
Is where you're going with that though as well? Is it is because it sounds like you're in leverage sort of stuff, which means you can have margin calls and liquidation, but also it's easier to sell. Is that kind of, let's just say if you saw a 10 to 15 or 20 or 30% crash in the share market, people may potentially just sell. Is that what you're also talking about, or is in property it's a lot harder to sell that asset? You can't go and sell a toilet if it goes down 10%.
Well, let me put it to you this way. Okay, so where I used to work, we used to offer leverage, often like 100 to 1, even 400 to 1 leverage. And so we had like 100,000 customers, like 10 people made money, everyone else just lost money. It was effectively like a gambling operation. So like if you were perfectly right, bought something and never sold it and it never went down, like, yes, okay, you could turn 10 grand into 5 million or something. But the amount of people that did that was no one, because it was just too much leverage. So, and if I look at having dealt with hundreds and hundreds of clients now, when I look at people's assets and liabilities now, it's very rare that I see someone got rich investing in shares. Not to say obviously can't, but just what I've seen. So that's, I guess, played a little bit into my decisions as well. Yeah.
Yeah. Well, I mean, that's why I love property, is because you have a 20% deposit, and it's only like, that's what was your deposit initially? $15,000. And the bank is so comfortable with this asset class that they're willing to give you the remaining $190,000 because they know it's going to go up in value, and they're not ever going to take it from you unless you don't pay your mortgage. But unlike with leveraged shares, which are at 100 to 1, 50 to 1, 4 to 1, it's crazy. They can just call it at any time if it starts to go down. If the value drops below and you're like, no, I know it's going to drop below this level, but it's going to bounce back up. They're like, too bad, we're calling it because you're too risky. Exactly. Awesome. Okay, great. So we've got this place in Liverpool, and Mount Druitt starts to tick a couple of boxes. What was it that drew you to Mount Druitt? Because Mount Druitt.
So I guess it was partly that, like, the reputation was really, a lot worse, I think, even back then. This was around 2013 that I was buying those properties, and the yields were really outstanding. And at that time, I started to follow Nathan Birch. Much credit to him. He puts a lot of free content out online, and he sort of gave me some confidence, that, those were still investable sort of assets. And once I started to sort of dig around, I found that there wasn't that much competition for those properties at that time, and they were selling for a song. So the first one that I found, it's actually a suburb just north of Mount Druitt, in the regions above Mount Druitt. There's like a bunch of suburbs. So it was like a 3-bed. I think the first one that I got was a 3-bedroom townhouse, and I think from memory it was like 210,000. I think I paid for that. And I think the rent was in the region of 300 a week, maybe even more. So again, in that time, I was not only had I gone from the first one being an apartment, this actually 3 bedrooms plus a garden. So I was like, I'm getting a lot of property for 210,000 was sort of how I saw it. Yeah.
What was your sort of metrics here? Because it sounds like it was mostly sort of a cash, I'm thinking now it kind of sounds cash flow, but what did you sort of think around the capital growth side of things? I'm just interested to unpack you.
Yeah, it's a very good question. Look, to be honest, I don't know if I ever sort of said the double every 10 years thing or something. I've always been more in the camp that sustainable is probably more like 3 to 5% plus the yield was what I sort of preached that in the old days. And yeah, typically these were bought with a 6% yield as a minimum, was generally like what I wanted as a benchmark. So I was a bit more yield focused back in the day. And I think the interesting part with that is that, I guess over the years you sort of look at it, and I look at how much I receive in rent versus, the capital growth. And then you just realize sort of how insignificant it is. But I guess you do have to give a little bit of credibility that, had I not had good yields, maybe I couldn't have held the whole portfolio as long. So, that's always the bit you've got to debate. But yeah, that was I started off with a cash flow mindset. That is right. And just thinking the growth would be steady, not surge kind of thing. Yeah.
And that's a very safe approach to take, because if you go to an area expecting all this capital growth to be able to do it, but if you go in and say, I've got a supporting asset here at 6% yield that's going to look after itself and keep growing, and if it's got other key indicators, like it's got infrastructure going in, it's got a new school, it's got all this other stuff to support the theory of maybe it's going to grow, then that's a property well worth checking out. An area well worth checking out for sure.
Yeah,
exactly.
So go on. So you bought number 2 in about it was 2013 from memory.
Yeah, so that was around start of 2013. So that went through pretty smoothly. Again, I think I had a tenant straight away. And I looked at that and I was like, wow, the first one was good. The second one was great. And I was like, well, if two's good, three's better. So I went back to the same agent, the same broker and the same agent. So the broker got me another real estate agent. I went back to the same real estate agent. I said, mate, I love that purchase. Love the area. Have you got anything else for me? And he said, you just tell me what you want. I'll go door knocking until I get you the stock you want. So I was like, beautiful. So then
that's not going to happen today, people. The agents are not going to do that running around for you in this type of market.
It did get a little bit funnier. Like, so I bought the second one through him. I think the second one was the 4-bedroom next door in the same block. That one I paid $237 for it, and that one I had rented like enormously. I think I had it nearly $400 a week or something at the start, and then I think I had to later reduce it to like low 300s. But I had something like an 8% yield, some ridiculous number on it when I first got that one. So and then I bought the third one, same agent, same broker again, exactly the same thing. I went and said, let me do another. Went back to the guy, he door knocked someone in the same block, and that was a 2-bedroom. And we said, all right, we've got 2 comparables from the last 6 months in the same block. So based on those, your one's worth this. So then they said, all right, come and have an open home. So then I went for the real estate agent the night before. It was their Christmas party. And he actually called in sick for the open home on the Saturday. So he didn't even turn up. So I called him. I said, I'm here for the open home. He goes, I'm sick, I'm not turning up. And he goes, just knock on the door and the guy will let you in. So I knock on the door. Guy does not let me in. I can't get in. So I just called him. I was like, listen, mate, this is no good. I said, I'll just take it anyway. And just bought it. So I've never seen it, never been in. And just there you go. So I knew the block that well by that point. I was like, I know what's in there. Wow. And to this day, I've never seen it. So there you go.
So how many is in this? How many is in this block that you bought, JP? Like, are we talking sort of heaps? 8. There's a lot of it.
8. So I've got 3 out of the 8 at the moment. Yeah.
That's
sorry. You own 3 properties in the same block of 8.
Yep. So basically, I control the strata now. They can't do anything because I've got all the votes. But look, there's more issues behind that. The strata has gotten expensive, and I'm trying to reduce that. I've been through the financials, and they blame the insurers, and they say we got 3 quotes, and anyway. So that's a whole nother story. But yeah, there's a number of joys that come with that, and a number of problems too.
Yeah.
Lenders don't like the concentration of having the ownership of so much in one block. So yeah, there are some challenges with that as well.
So were you going with the same bank every single time?
Yeah, so at that point I was still running everything through CBA. I think that was kind of the favorite lender of the guy, and that worked for me because I was like, I had the CBA bank account since I was a kid, so I felt comfortable with it. So that was sort of that got me to 4 in Sydney, and then the next one wasn't until 2016. So that was a big break. The last one, I think, in the 3 Mount Druitt region, it was early 2013, late 2013, and I think the very end of 2013 or early 14 for that. And then it was 2 years before the next one.
Yeah.
So I'm interested about this agent relationship that you set yourself up with, because this guy buys you 3 properties and they get you at a great rate. How did that go? Because I know there are some really great real estate agents out there that I would only sell, like I would sell my property, I'd get them to sell my property for me because they're absolutely guns. And then there are real estate agents that I would only ever want to buy off. I would never give you my property to sell. And generally speaking, it's the ones that I would never sell off are the best ones to buy off. Give us a bit of what was his kind of background? Was that the kind of relationship that you guys had, or how did it look?
Yeah, he was a sort of a blokey bloke kind of guy. As I said, he called in a sickie on the open home. So I mean, maybe that kind of give a bit of an indication. And he was the owner of the agency, and he's since sold the agency. So I guess he's kind of like I don't know. He was a salesman kind of guy, but.
I probably actually know this guy, JP. I mean, I grew up in Mount Druitt, and I've sort of seen. I know a lot of this. I mean, I wouldn't say know the real estate agent, but I've probably seen the name around. So maybe tell me after the show. I'm kind of interested now. But
Nice.
yeah,
There we go. Any questions that anyone in the audience has, start throwing them out there, guys. This is an interesting story. So now we've had a bit of a delay. We've held out for how long? How many years before you bought your fifth one? And why? So you were crushing it, man. Was it because no one in that block was selling, or what made you break?
Well, I ran out of serviceability, and I was fighting with my employer at that point. I couldn't get enough income. They kept promising to pay more. Head office wasn't signing off on higher incomes and everything, and so I was still struggling with quite a modest income at that time. So I hit the wall there, and that's where 2 years later I discovered this other broker, and where he was talking about structuring multiple loans across multiple lenders, putting it on IO, and then having actual repayments with a minor buffer going on there. So that's when I switched over. From memory, they were across then NAB and Macquarie, and maybe one other lender as well. But yeah, more aggressive lending, I think, from Macquarie back in the day. So that got me to the fifth one. That one there, there's a few things behind that. So a few lessons to unpack on that one. So, okay, I got into the 2016 point. Actually, I was very low on savings. The portfolio, while it was supposedly positively geared, the holding costs were higher than I expected. And so I didn't have a lot of surplus cash. In addition, I couldn't service much more. Now, this new broker, he found me, got me a lot more serviceability. I cashed out quite a lot of equity, but I didn't use all of it because I was so scared of being in a position where I had no liquidity and that I was going to run out of money and lose it all, that when I refied the equity, I didn't use it all. Now, this was my biggest probably mistake. So this was 2016, right? At that time, he could have got me from memory up to about a 550, 600K purchase. And at that time, I could have got a house in the greater Wollongong region region for that price.
Oh, jeez, man.
Now that would be
You could have got two houses. You could have got two houses in a very in an up and coming sort of area, mate. You would have. I'm not saying that people can always lose, but you would have been able to double your money. Like literally, you would. Yeah.
Easily.
So can we just go back to what you were saying there? So what were you trying to do? You had cash. You had equity built up, right? We've been doing this for 3 years, 4 years, and now we've got a lump sum here that you pull out. So you pull out $200,000 and put it into an offset account to be using as deposits for your next purchases.
Yeah, from memory, it was about 120, and then I think I kept about 60 or something of it, and then I was like, I'll use in liquid assets, and then I was like, I'll use the other 60 as a deposit, and that's really I think where I sort of screwed up a little bit, and I should have leveraged more and gone all in. So what I did was I wanted the cheapest freestanding house within the outskirts of Brisbane that did not have strata, because I'd gone through the hell of strata. I wanted a house. Everyone was talking Brisbane. The purchase prices were lower. The yields were still good. And so I ended up buying the Red Bank Plains region, which everyone told me was somewhat similar to Mount Druitt in Brisbane. And Logan was the other one people were sort of talking at the time. And look, that probably would have been similar outcome, I think. And look, the place it's been all right recently. Like I think now it's up maybe 30% or something, since I bought it. But again, it's just nothing compared to if I'd re-leveraged back into New South Wales. The second lesson I really had from that purchase was that I should have used a buyer's agent. I had one of my other friends buy in Queensland later, and he used a buyer's agent. And his property in Queensland is much better than my one. So that was another lesson that I sort of learned at that time. If you're not buying where you should be spending the money to get a professional. Even though I live and breathe investing, by that point I, considered a big investor. No, you should hire a professional. That was the other lesson I learned from that. Yeah.
And what was the difference in capital, right? And what was the difference between what your assets now worth and what his assets now is? Your property versus his property now, like from an actual value perspective?
I'm not sure exactly, but the growth rate has been dramatically better. I don't know if his one would have doubled in the same time, but it will have dramatically outperformed by at least a couple of percentage points. So it would have paid the buyer's agent's fee 5 times over, probably at least. Yeah.
And are we talking kind of he bought inner Brisbane, or did he buy kind of middle ring Brisbane? I mean, I don't know if you know this.
I think his one was like 30 minutes north of Brisbane. It was like maybe not even that long, maybe 20 minutes north of Brisbane CBD, and it was like a proper freestanding house, and they'd been tracking it for ages, these buyers agents, and it was quite good by comparison. I think it was sub 400,000 at the time, and I think it's done fine. But I mean, yeah. Look, again, that wasn't the world's best purchase either, but it did significantly outperform the one I tried to do by myself. So that was one of the lessons.
Yeah.
But
So
yeah,
you're talking like your property is now worth 500,000. His property is now worth 650,000. Like that kind of difference in price.
I think so. My one I paid 253, and I think it's worth like 320, something like that. I think he paid 400, and his one's worth like 650, 700, something like that now. So that's where it's kind of like, well, probably should have spent a bit more. Use a buyer's agent, yeah.
Well, the question, Kim, I want to take a step back because we've kind of we'll get to that. That's probably your second last purchase. So you've made one more purchase. I think. So I kind of want to unpack. So you bought those 4 properties in Sydney, then you got the 5th one you were looking to buy. What was where was your mindset in terms of your investing? Were you looking at we're still looking at mostly cash flow? You said you wanted to buy kind of a house without strata because you had strata issues. Were you still where was you headed in terms of what you wanted to achieve?
Yeah, so exactly that. I guess my journey has kind of been learning on the lessons from each prior purchase. So yeah, I wanted a house, so no strata. I still wanted to be related to a capital city at that time because of the growth, and look, my views are changing on that a little bit now. And yeah, I still wanted it to cash flow so that it wasn't going to impact my lifestyle. My plan long term still at those times was sort of the retire early, retire young kind of thing. So I wanted to have a portfolio that at least sort of covered itself so that I wasn't going to be, that was sort of the perspective I had still back then. Now this obviously changing a little bit with time, but yeah, still a bit more cash flow leaning, with capital growth being still important. Like you could always buy the regional 100 grand stuff, and maybe in hindsight that would have been good, but I didn't quite go the full Steve McKnight, but I wanted good yield within a capital city. Yeah.
Interesting. Okay. So you had more of that, cash flow focus to be able to then actually it looks after itself, and I can then hopefully get some growth, but it's going to support itself. I'm never going to lose it. I'm never going to lose the ship.
Exactly. That's kind of that's been the goal. And interestingly, my parents they had a bunch of 3 apartments in like a area that was not considered very good in Auckland before we liquidated everything, came to Australia. And those apartments now I think are multi-million each, like dollar properties.
Yeah, New Zealand's gone absolutely crazy. Like, isn't Auckland one of the most expensive places to live in the world now, like in terms of housing?
Yeah, so that was, I guess, one of the lessons too, that one area that people screwed up their nose to when you were young can later become, a place worth a lot of money. And so I guess I've sort of carried that view all the way through. Yeah.
Yeah. And what is this still possible, right? Because lending back then was a little bit loosey-goosey, but you were still coming up with the exact same challenges we hear today. I've hit 3, I've hit 4, I've maxed out my serviceability. Is it still possible to do what you've done, but in a different location? Because obviously you're priced out at that point. Mount Druitt.
Exactly. And I guess one of the things that I thought was really cool about what you guys are doing, like the stuff that I saw you guys presenting recently, I must admit I'm not an expert on like the Shepparton region, but when I looked at that purchase, that really made me sort of feel like I was back in the old days. I was like, here's a sort of foundations of property, if you will. You feel like you can feel stable. The location's going to still be good in 20 years. And, you've got the yield to support you in the interim. So I definitely think it's doable. And today, I'd probably be considering, your Sheppartons, maybe you're looking Brisbane, maybe you're looking on the coast somewhere more regional, which I wouldn't have considered as much before, but now I would. Maybe you would look WA or South Australia. So it's probably a bit harder in Sydney and Melbourne, but certainly I think there are still a lot of locations where you can start out, basically at a low purchase price if you're not earning much and don't have many savings as yet. Yeah.
Yeah.
And
I was going to say, should we unveil where you've sort of where you're considering kind of, well, not where you're considering what you've purchased most recently, and kind of
this is actually the interesting point, Jeff. I like that you bring this up, is because this is what we said at the beginning of the show, and that you've turned these Mount Druitt properties into a blue chip asset. Now, one of the things this whole thing that you're talking about is rent vesting. You've been rent vesting your entire life to be able to buy assets to get into a blue chip location. If you want to live in there, that's up to you, but it's a good capital growth play. So now you've got your cash flow engine sitting here, and then you've got your capital growth play. Now, I'm not saying that that's the best way to structure a portfolio at all, but yeah, is just buying a PPOR in a city a great way? Well, in the most place you can afford, or is rent vesting the way to build a sustainable portfolio? What are your thoughts on rent vesting or buying a PPOR sit and hold?
It's a very good question.
That feels like it feels very loaded, that question.
It is a very good question. I think a lot of it will come down to execution. So I think, look, in the perfect world, rent vesting probably is superior in that you can accumulate a larger total asset value. Now, in practical reality, someone has to actually go out and execute that transaction. So one of the things I talked about a lot on the podcast in the past was, when I look at people's asset and liability positions, most people actually have made all their money in the PPOR. And it's not because like the home is the golden ticket. I think it's actually because when they buy a PPR, they hold for a long time and they buy the best asset they can. And when you buy a great asset and you hold it for a long time, that's where there's a lot of growth in it. Versus for investments, by comparison, often you'll see someone, they're like, oh, for my home, I want to buy a $1.5 million house, blah, blah, blah. Then you talk to them about they buy an investment. They're like, oh, let me go buy $500,000 in some random area or something like that. And it's like, well, why is it that way? The quality asset is what's going to grow. So I do think that for a lot of people, a PPR is actually a solid way to build wealth. But obviously there's a lot of challenges around, the cost of getting into good properties in capital cities, especially if you're starting out young, if you don't have much of a deposit and lower income. Rent vesting can give you a really nice way to start building equity, build that portfolio, and then you can sort of springboard off that later in life. That's sort of the way I think of it. But look, if you're earning $1 million a year as a surgeon and the bank will lend you 100% because you're a surgeon, well, look, I'm open to someone buying a massive PPR as well. I think that can make money too. So yeah.
So what you're essentially, to sum it up there, JP, you're talking about being an investor with an owner-occupied mindset. Is that kind of what am I picking up what you're putting down, or is it?
Well, I guess one of the things I always want to talk about with my podcast was I always want to talk about what I see with actual people's asset and liability position. Like I see people, how they actually got wealthy. And yeah, one of the things I really found is a lot of the money is in the home, but you have to dig deeper. Like, why is that? And I think it's because when people buy a home, they typically do like a 95 LVR, or they pull everything they've got to buy the best asset. And then they try.
You're actually living that.
Yeah, and they hold on for dear life to own it. Versus like when someone buying an investment, they're like, oh, well, maybe I can find something for $300,000. And that's where I was sort of saying, like, if I look back on the Queensland purchase, maybe I should have gone all in and just bought some house and dealt with the risk of it later, kind of thing. So, I think that rent vesting is good, but you got to make sure you're buying quality assets. Yeah.
Yeah, that's actually a great.
I wanted to, because you sort of talked about it in passing, but what would you say are the characteristics of a quality asset?
That's another good question. So quality asset, like I would say generally the best thing you can afford. But look, house is obviously superior to a townhouse or a unit is how I see it. Location generally I think is going to trump almost anything, but I don't believe that necessarily every established location is going to outperform a developing location. Like I think if you can pick the right hotspots, then they're going to do the best. But look, there's a lot of more specific parts that can go into that talk. Yeah.
Yeah, I find that actually interesting. So I'm driving around. I don't know what state I am in now. I was in Adelaide yesterday. I'm in Queensland today. But when I'm driving through the town, I am still always asking the question, where would I want to live? And then I think, where would I want to have lived when I was 10 years younger? Where would I want to live? And not that I know what I'm going to be in 20 years' time, but I'm like, where would this type of demographic want to live? And if the answer is not here, then generally speaking, I'm like, can I see this place moving up to the next level? No, it's still putting your owner-occupier head on, because the owner-occupiers are the ones that drive the value. They drive the value up by keeping their properties nice, upgrading, updating, and all of a sudden you're on a beautiful street and there's lovely house, lovely house, lovely house, rubbish house, rubbish house, lovely house, lovely house. And then all of a sudden that whole street is brought up by the lovely houses, and then you can pluck out a good opportunity in the not so great one. So always buy a good, the worst property on the best street rather than the best property on the worst street. It sounds like that's what you're kind of telling us here, John.
That's the lesson from my parents. They've done it over and over again. Like they've done it multiple times down in Berry. They buy like houses that are the rubbish, and then they rebuild it or they add on to it, and then it's worth double like 2 years later. So I've seen it multiple times done by my parents.
Yeah,
just Berry in New South Wales, on the sort of in the southern highlands, sort of. Yeah. I mean, yeah, man. I mean, it's probably a bit expensive now, isn't it? Though, do they still do that?
Well, yeah, because they're living in those ones, so they do they build it up, live in it for a few years, and they upgrade again. And so yeah, and look, they didn't help me with any of their stuff, but when you grow up, obviously you start to sort of learn some of the stuff from your parents. And interestingly, they really tried to talk me out of investing in Liverpool. My dad wrote me this formal thing saying, "I think you're making a mistake." I did it against his advice. And then I bought Mount Druitt, and he said, "I think you should stick with Liverpool." Once I bought Mount Druitt, so it's funny how your parents.
Come on, Dad. I'm going to find the next worst one.
Yeah, interesting. Okay, so I'm just thinking about so you picked up. I lost my train of thought there slightly because I asked the question.
Okay, well, let's go to an ad because we need to run through the ad. So let's pop that on now if everyone's cool with that.
Keep throwing your questions up now. Audio, Joe.
This live session is sponsored by Scott Agate from Hello House. Scott has created the world's first property negotiation as a service business. So what does that mean? Well, let's think about it. When was the last time you negotiated on anything over $100, let alone a property that is going to be one of the biggest investments of your life? The vendor, they have a trained negotiator on their side in the form of a real estate agent. That's kind of like you stepping into the ring with Mike Tyson after never training a day of boxing in your life. These guys are trained professionals, and that's what they do day in and day out. And this is what Hello House does every single day as well. They negotiate on property to get the best buy price from the real estate agents. Scott Agate, he's the expert negotiator. He has been in this industry since 1995. He owned and operated 3 Bell franchises. Scott was the guy that was teaching these real estate agents all these agent games. He knows all of their tricks. Having him on your side is going to give you a massive unfair advantage and literally save you tens of thousands of dollars. Unlike other ways of purchasing property, Scott's incentives are aligned with you, the buyer, meaning the more money he saves you, the more money he makes, which is what you want. You need to have those incentives aligned. Scott has kindly offered our group a massive discount on the retainer fee for his service. So if you're looking to buy your next home or investment property, click the link below to get in touch.
Yeah, there we go. And people are asking for what your podcast is, JP. So it is called the Australian Property Podcast. So I'll pop that link. But I suppose the thing that before we kind of got to questions, and because there's going to be a heap of questions, there is already a few in there. And I've already got a couple of pre-prepared. Tell us about number sort of your latest or your last purchase. Like I think it was number 6, if my memory serves correct. Like what was the kind of rationale?
This is the conversion. This is dirt cheap to blue chip. How did it happen?
So I'll give you a bit of backstory on the mindset there. So I sort of mentioned earlier, one of my goals when I was younger was that I wanted to do the retirement early. And if you look into that, what people talk about is that, you can basically spend like 4% of your net worth every year. And if you can live on that, you can effectively retire. So I kind of got to a point last year where I was looking at what I spend versus my asset position. And I started to get a bit demotivated because I was kind of like, well, I don't really need to work anymore. I got quite comfortable. So that's obviously a very luxurious position to get into. And that's, I guess, one of the beauties of property investing. And I've done pretty well in some other assets as well there. So I was sort of looking at last year and I was feeling really comfortable with a very, very large amount of liquidity. And so I was sort of like, well, all right, let me reverse engineer this. If I'm not going to retire right away now, if I am going to work another 10, 20, 30 years, just because, what am I going to do if I retire? Then, what do I want to own later in my life when I've got time to burn and when I'm not, like as able to borrow as easily and all that kind of thing. So I started to change from a pure like numbers based perspective to like, right, what do I want to own as a person for later in life? And so basically with this one, this is an entirely different thing. I went from all my prior lessons. So this time I was like, right, I'm going to use a buyer's agent. I'm going to basically go almost all in, maybe not quite all in. That's not quite true, but I was going to go to a level, the max that I felt comfortable. And my intention lifetime has always been that I want to be able to, like later in life, live in multiple locations at once. So maybe live in one or two overseas countries, maybe have a country house here and then have something in Sydney. And I started looking at it and I was like, well, a house in Sydney is going to be a big purchase. And if I'm going to be traveling a lot, do I want to sit that vacant? So I thought, look, if I get an apartment, it'll be very liquid in terms of can sell easy. I can rent it easy. And then later for my strategy, 20 years down the line when I'm traveling, I'll have sort of a home base in Sydney. So the sacrifice I made, and this was, is questionable. Maybe I should have bought a house, but I went with the unit, old walk-up style one. It's 600 meters from the beach in one of the eastern beaches in Sydney. Purchase price was just under $1.5 million. So this one was, this is on the complete other end of the spectrum. It's negatively geared enormously. I don't think it's going to be the world's highest growth property, but based on, eastern beaches, 600 meters from the water, I figure, look, worst case, I can sell it very, very quickly. Like if this goes on the property, if I put that back on the market, I'm going to have it sold probably within 2 weeks. Renting it, it's a dream. So doing renos at the moment, depending how much I reno, I can probably get between $725 and $900 a week. So you can actually get quite high rents in the region because of that area. So renovation potential, all of that. But yeah, so completely different purchase to all my other ones. Yeah.
Interesting. So does the cash flow you kind of use the cash flow from that to support the weight of this asset? And then some, I guess, if you can retire.
The negative gearing is not too bad. Like we're looking at, say, about 1% a year is the negative gearing, like after everything. So if the property grows 1% a year, I'm net even. If it grows 2% a year, then I'll be up. So it really doesn't need to grow enormously. Historically, capital growth is near 7% there. So I mean, I'm not betting on that, but let's say we even use 5%. If I have 1% negative gearing on it, 4%, margin on it, roughly $1.5 million purchase price. It's about 60 grand of, theoretical equity I expect per year based on a 5% growth rate. So that's kind of like that's the conservative math I'm doing. And look, that assumes rates going to stay the same, which is not a sure thing. But that's the quick and dirty math I did in my head. Yeah.
So you said you sort of, oh, sorry, yeah.
Go, mate. Go.
I was going to say you said you compromised on buying you bought an apartment or a unit versus a house. What was it because you just couldn't buy a house in the location, or what was the reason you decided to not buy a house?
Yeah, it's a very good question. So location and the difference between apartment prices and house prices, I found, has become really, really big in the prime areas. basically, like if I was to look in a similar around where that property is, if I was to look at houses in that area, I think it's 3 to 4 times the price. So it's not like a small difference. And then for that purchase price, if I was going to cap it, say 1.5 mil, yeah, there are properties that you could buy, but I'm sort of going to be buying, say, an hour north or an hour south of the city, sort of in some direction. And I feel like from a rent perspective, it won't be as good. Like the ownership cost of a freestanding house, I believe, is quite a lot higher in a lot of cases, like especially if it's a luxury one. So that was my sort of concern there. Now, if I looked at this with a pure, and actually I should, before I move on to that, the other place I considered, it was between this or a house in Terrigal, Wamberal. So that was the close comparison. But if I was pure numbers based, I probably should have bought the Byron region. That's where I see the growth.
Ongoing. Yeah. You see the ongoing growth for Byron.
It's kind of it's kind of interesting you say that, because like Byron, you've seen, I don't know the exact numbers, but I think in the last sort of 12 to 18 months, I think you've seen somewhere like 50, 60, 70. I don't know how much growth it's seen. But so what do you think? What's your thesis behind the Byron, that sort of region?
Yeah, I mean, I saw the other day, I think median went from 1.4 to 2.7 in a year. And I'm a bit spewing because the last like 18 months, 2 years on the podcast, I've been saying, I don't know why, but Byron is where you put your money. And I actually only went there for the first time like 2 weeks ago, and I was only there for a few days.
There's only one road though, JP. You can't get in and out. It's just like you crawl in. I don't. Yeah. When are they going to upgrade the road?
I turned up and I was like, look, I don't know what all the fuss is about. And I was like, but the people who have all the money, this is where they want to be. So, you don't fight the trend. That's where the money is. So I'm not necessarily saying to buy Byron, like town center, maybe a bit south of that. But even today, I was sort of like thinking, well, let me inspire myself for this year. So I reached out to, I think it was 4 different buyer's agents, and no one even called me back. So, I mean, like that shows how much demand there is. And one of the guys did message me and said, mate, there is no slowdown here. You better be talking over $1 million kind of thing. Like, so that should be an indication as to how hot things are up in that region. Yeah.
Interesting.
There you go. And is it the lifestyle? Is there is it because of the shift of people not necessarily want to live in the city? We're now becoming more interconnected and people are flowing out from the cities. Do you see like, an inhale and then an exhale back into the cities happening, and that maybe chipping away at some of these lifestyle locations?
I don't believe that I've heard that a bit. To be honest, if you think about it, right, let's say you go to all the trouble, you move out of Sydney, you relocate the whole family, you put the kids in the schools and, all that. I mean, how many of those people are going to turn around and flip and come back? I mean, yes, look, some of them will, but I do think that a lot of this isn't going to be reversed. And then if you look at workplaces, I mean, they can't even reopen this stuff back up. This COVID, we've already been 2 years of it. And I'm of the belief we're going to have this for many more years. So I personally don't see that it's going to shift back to cities. And that's why I think purely numbers based, if I'd bought regional, that probably would have been better. But as I said, it was partly a future lifestyle thought. Yeah.
Yeah. Yeah. Well, you're saying Byron's regional, is that what you mean?
Yeah, or even like, just other coastal areas, all these sort of regions.
Yeah, lifestyle. Yeah. Okay, yeah. Fantastic. Well, everyone, pop in some questions. Let's jump to question time with the audience.
We want to do, while we're waiting, I was going to say, while we're waiting for questions, we definitely have comments, questions, all that sort of stuff. There's going to be heaps. So I think the thing that I promised we'd sort of go through a little bit, and I'm not expecting an hour summary on this, but just give us like maybe 5 points. Like what are and given that you speak to hundreds of clients a year, your own investing as well, what are those things that you wish you'd have done? You sprinkled them throughout the conversation, but let's crystallize those 3 to 5 things that you would do now.
Yeah, so generally use a buyer's agent. Look, if it's your very first property, that might be hard to stomach because the fee is a bit higher. But look, if you're not using one, you need to be very careful. So I would say that's one of the key lessons for me. Second thing that I've learned over the years, and I heard this even said on a US-based podcast the other day, and actually people hate hearing this, but I think it's important to say, residential regulated lending is not a property-based thing. It's lending against salaried income. And so if you want to borrow a lot of money, you need to earn more money. And that's what one of the brokers said to me. Like I said, I want to keep building the portfolio. He said, you need to earn more money. And I said, but I like where I am. I don't want to move. And he said, that's fine. He said, but that's your choice. You're choosing to not build your portfolio more. You're prioritizing lifestyle. So I think one of the key things is that now, having been a broker, I actually get to see everyone's jobs, right? And so I actually have some suggestions as to how people can earn a lot more money. So first, if you're not very well educated,
okay, here we go.
Go into to be a FIFO worker. Step one, if you're not very well educated, or learn a trade. Both of those you can get well into six figures. Secondly, if that's too much hard work for you, go into sales. You don't need to be educated at all. I've seen guys at Harvey Norman earning 100,000 and more. So sales is where you can make money if you're not very well educated. If you are educated and you want to work in an office or, like a remote or something, tech or being a programmer is where you should be. And then the last thing, if you don't want to work at all, or if you're an idiot, go into government or be a politician. Those are four ways you can earn.
Yeah. Well, when we're live, we can't cut out Jonathan. I don't think you're going to get us cancelled, mate.
We love anybody. We love most kind of. I mean, as long as you're respectful, we'll have you in the group. So whether you're educated or not educated, no judgment. I mean, some people would say I'm not super educated. I mean, I may have a degree, but it doesn't mean I'm educated at all. But interesting, yeah. Man, I love it. So
I don't mean to insult anyone there.
No,
I just when I was when I was stuck on the 50K wage, I wanted to know how to earn more. So I'm just sharing that info with people.
100%. And it's a pure numbers game for you as well. That's what I like. Even when you talked about the blue chip location, you're like, it just needs to go 1%. I was like, well, what do you mean? What? I don't understand. And you're like, no, it just needs to grow 1%. Sorry, it needs to grow. If it grows 5%, I've got 4% left. So it doesn't matter if it's that, net negative by that 1%. That's interesting. So it's purely numbers based for you. And that's what investing should be. One of my things that I'm kind of thinking about is the way that lending has gone. Is that back in the day when you were purchasing your Mount Druitt property and your Liverpool property, we used to have property being 70-30, a finance game, and 30% property game. But now with the difficulty in servicing, it's now like 98% finance, 2% property. I don't know. Is that a right assumption? Like, is it becoming so much more of a finance game?
Sadly, yeah, and I think it's because it's really regulation based. I think that this might see a change in the future years. Like what happens with regulation across everything is that things tend to get more regulated than they unregulate. And look at like say US, Obama brings in all the regulations, Trump removes all the regulations, and then Biden brings it back. So it happens over the years. So look, at the moment we do have a lot of very difficult regulatory stuff in place, and they're moving toward like the 6-7 times sort of lending ratios and stuff. Really, if you want to be a big investor now, you need to be all non-bank. Like I spoke to a guy just the other day who's relatively new as an investor, and I think he's at 8 resi properties already, all across non-banks and everything. So that's just the modern way now. You have to be comfortable getting away from the banks. So look, it is harder. But I would say, there's a lot of opportunities to make more money these days than there used to be. Like these days, the inflation in wages, especially in Sydney and Melbourne, it does exist. I don't know why, but people are earning a lot more than when I started as a broker just 6 years ago. So if you're not getting treated well by your boss, get a different job. Yeah.
Yeah. Should we throw to some audience questions? I mean, I think I've kind of, but so Gurav said mortgage strategy. So I'll actually unpack. So he did put a longer question in. So he said he some of the things he asked. What are some of the recommended loan strategies for multi-property investments? Cross collateralization or non-cross? Tips to improve serviceability. And he said, what do lenders like more, cash flow or capital growth? I know that's a lot of questions. So do you need me to?
Let's maybe attack one by one. So with the capital growth versus cash flow for properties with lenders, that's not really a thing that gets looked at all. You sort of get people online lecturing, saying, "Oh, well, because I buy the right properties, the bank likes me and all that." But we all, like, anyone who's worked in lending knows that's not the case. It's a box ticking exercise. The bank either will take the security. Exactly. So that's kind of like on that bit. Serviceability.
Wait. What do you mean? What do you mean? I don't understand what you said just then.
Do you fit the criteria? If you don't fit the criteria, computer says no. I don't care whether you buy a capital growth property. Is that what you?
And so what are some of the criteria? Like if it's a negatively geared, low cash flow property, what's their kind of threshold? Is it not to do with the yield?
No, it's not. So what happens is, the calculators these days. Exactly. You'll put salary income in, you'll put the amount of rent, and then you'll put your lifestyle expenses in and any other liabilities. And then basically, like, here's what you can borrow. And then from there, the property is a binary. Is it does the property qualify or not? And like, assuming it's a house, unit, or whatever, like, as long as a normal resi property and, it values on price, then that box is ticked. They don't care whether it's a mansion in Vaucluse or whether it's a 1-bedroom shack in Mount Druitt. If it's accepted as like acceptable security, the box is ticked and they move on, kind of thing. So they don't look at it, oh, this guy's buying in a crap area, we don't like his loan. And look, the one caveat to that, okay, if you're going non-bank, and if you are going to be especially low doc and you're doing like $10 million of lending, then they really do care about your properties. Because when you go not like the private style lending, they're almost assuming that they're going to repossess it. So they're more interested in that point. But assuming you're just starting a property investing journey, the capital growth versus yield, it's not like the assessor at the bank looks at it and goes, "No, we don't like that one, let's move on." It's not like that. Yeah.
I suppose I'll add a bit more color and just so, I mean, you and I probably both know this, but it's more around if there's a high density kind of postcode, they are concerned about that particular area. So it's just to add another layer of complexity to. So it's not so much necessarily the asset; it's maybe the area and the type of asset you're buying that can be a consideration.
And there are maybe we should do this in our newsletter. Like, there are programs to see which are the kind of hot, and the banks obviously have them. Where do banks not want to lend money to? So there are locations throughout Australia where a bank will say, no, we don't. If anyone wants a property in X location, hell no, we're rocks cross. I
can do a write-up on that, Joe. I mean, I can write it and you can make it look sexy.
There we go.
Maybe JP can do it anyway. You can probably write it much better.
There we go.
So I think Gurav, you did ask a couple other questions, but let's. I think that answers.
Thanks, Grav. That was good. That was fantastic.
So this is kind of an interesting one. I don't know if have we sort of answered this? I don't want to cover it.
No, cover it off again. Let's just go through it.
Which
is more important, serviceability or total debt to income? What do you do if you have great serviceability but high total debt to income, or vice versa?
So the issue with this is that the debt to income, so we call it DTI, that is regulated. So that's the problem. So a few banks can do more than 6 times, but unless they're one of the ones that does, a lot of the lenders now have a hard ceiling at 6 times. So it doesn't matter if the servicing says you can go like 10 times, which no one ever can. The 6 times cap overrules it, and the bank, I believe, is not even allowed to overrule that. Like some of them have been instructed, by APRA, 6 times is your hard cap. So even if the calc says you can go borrow like 20 mil, 6 times, that's it. The bank is not going to breach their covenants and then get in trouble for their own capital ratios and stuff like that. So debt to income, sadly, is the overwhelming one. The workaround with that, some of the big banks will allow a higher than 6 times, and a lot of the non-banks don't have a DTI at all. So again, it comes back to getting comfortable using non-banks.
But then some of those non-banks will have serviceability issues. So will they? I imagine still. JP?
Well, and obviously their interest rate is going to be a little bit more to justify the risk that they're taking on to be able to take you on.
Exactly. Pretty much these days, it's rare to see someone more than, say, 3 properties that's not in the non-bank space now. Like you basically need a plan that you're going to be doing your lending through non-banks. That's the modern situation.
And what kind of rates should you expect from a non-bank? What are you kind of putting through, like with your clients that you service? What are you putting through the non-banks?
Maybe 3.3, 3.2, something like that.
And how much was your interest rate when you got your first property?
It's a good question. I think it was about 5%. Like, it was a lot higher. Maybe
that's pretty sharp, though.
It's bloody sharp. That's what I was expecting. I wasn't thinking. I thought you were going to say like 3.9, 4.2, 3.3.
No.
Yeah, I was talking more about the rate.
Yeah, the first one, I think it was near 5, and it went through like 2 or 3 rate rises, and then we had all the rate cuts in the last few years. But it was dramatically higher than when I started. But it was still positively geared, even at that higher rate. Yeah.
The questions have absolutely just flown through. So, how are you tracking, JP?
Sorry, let's get to that.
We can do another 10 minutes. Let's do 10 minutes more. Yeah.
Okay, let's smash this question. So this is maybe even a question for this is a question probably for JP. Do you pick a buyer's agent first, or pick a region and then a buyer's agent? What's more important? That's an interesting question for Mark. What are your thoughts, JP?
So mate, this is another very good question. So this, I would say, it depends on how much confidence you have in the area. So, like as I was saying, I'm a big believer in Byron. I don't know why, but for some reason in my bones tell me to buy Byron. And so, with that, if I'm believing that, then what I would want is a hyper-focused person who lives in the area and all they do is buy there. Now, if I didn't have such a clear view as to where I want to be, that's where I would potentially be finding the buyer's agent first. Like, for example, I did consider buying in South Australia a while ago, and what I was looking at were buyer's agents who were specialists in South Australia, who were doing the buy, reno, and rent stuff out there. And like with South Australia, I don't know any of the suburbs. So yeah, the answer to that is if you have a high level of confidence, you know exactly where you want to buy, then I would look for the specific buyer's agent for the region. But if you're new, then I'd be doing the research and then maybe finding like a really successful investor that you want to follow. And that's kind of what I've done. I've followed other investors with a lot of what I've done. Yeah.
Interesting. Now I feel like I feel like as someone who is a buyer's agent and is a borderless buyer's agent, I feel like I have to kind of jump in here, and I service clients in New South Wales, Victoria, and and where am I now? Queensland, right? But and South Australia. But one of the main things is like exactly that point. Where do you actually buy? Where's the best place to put my money? Where's the best location at the best price for my situation, for my individual kind of brief? For the buyer brief, we call it. But yeah, if you can try and find a buyer's agent that has the data, like that's where you got to want to go. But if you do think you have a location that's really good and you go and to a buyer's agent in that location, it's like going to a barber and asking for a haircut. So you need to do the due diligence yourself and find a region exactly like you do, JP, and listen to your podcast where you've got a whole heap of great insights in there. Jump in our group and just chat to the super successful people that are in here. Where are you buying? And then that gives you a bit of an indicator around, oh, well, maybe I should, get a buyer's agent that services that. But also, you got to be on the ground. Like that's what my whole trip is about, getting on the ground, meeting agents, crossing out the no-go zones and all of that stuff. So not shooting down either option. They both work. But it's just trying to figure out what's going to work best for you.
I think you fit in the expert category. You're obviously on top of everything, and you're obviously covering all the stuff in the group. So that's I'd count you in the expert category, mate. Yeah,
absolutely. Not absolutely. I mean, thank you, bloody legend. Let's go to some more questions.
Let's move. I want to get to these questions, Joe. I'll say you'd have to reach out to. Yeah, okay. You'd have to reach out to JP for that because I don't think it's fair that. I'll leave it up to you, JP, if you want to answer that. Reach out to JP, I'd say. But if you want to,
which banks don't have TDI requirements?
I think it's
great.
I think it's only non-banks for no DTI at all. There are some banks that I think doing up to theoretically 9, but I think every APRA regulated ADI now, I think they actually do have to have a cap. So I don't think there's any actual ADI banks, but the non-banks don't have them. Yeah.
Yeah.
I mean,
and this is why
wouldn't-
every single successful property investor that's buying right now is using a mortgage broker, because they're across this stuff. They're absolute experts in their field. And this is why you need to be reaching out to someone like JP to be able to cover it off and see what the heck is going on with these new rules and new legislations. There was a great question from Mark again. Mark
I wouldn't need.
Maybe. So have you had any negative experiences from the tenants? Now, going back to what you were saying before, you were saying like, I didn't factor in some things. What were those things, and were they negative experiences, or how did it kind of work for you?
Yeah, so look, I would almost say it the other way. I'm surprised if a tenancy goes well. That's how, that's what it's like. So most of them we've had, maybe not most, we are regularly evicting people. We are regularly taking the whole bond to get like rubbish cleanups of the house. I mean, I've had a fugitive renting one of my properties without me knowing. So they're the norm, not the exception, and that plays into it a bit. So, for example, like every time you have to get it re-rented, right? The rental agent wants, 1 or 2 weeks upfront, rental amount. Then, we've got to relist it on realestate.com.au. We've got to spend all the money cleaning up the property, have to keep repainting things, have to keep replacing items. The back fences people keep breaking into the back fence of the block. There's just endless repairs. A lot of out of the left center stuff. And even the Queensland one, right? So get this, the Queensland one, people climbed in on the roof at night. They took the tiles off the roof and they climbed in through the roof and then robbed the house while the people were staying there. And then the tenant said, we want to move out because we're scared.
Wow. That's a fair enough. That's an intense way to get into someone's house. That's creative. They need to change careers. That's because you're a smart kid. If you're breaking into someone's house through removing roof tiles, you need to up your debt to income ratio, or your income to debt ratio, actually.
Well, they are doing it, Joe. That's how they're doing it. I mean, not that we encourage that sort of stuff, but yeah, sure. Okay.
Side hustles. Actually, I got a question. Making income on the side, little side hustle that you've got that earns $1,000 a month or $500 a month. Is this something I should be implementing into my strategy? Because I love my job, right? I make enough money to support the blah, blah, blah. But should I be setting up little side hustles if I can't just get a raise? It's not that easy. Is that something I should be doing? And how does that kind of factor into our investing portfolio?
So yeah, and that's actually why I actually suggest some specific different careers for people, because sadly the second job bit doesn't work as well. So if it is actually a second PAYG job, typically lenders will require a lot of history to evidence you can actually work that many hours. And if it's a side hustle, like a business you're doing on the side, you'll need multiple years of tax returns to go with that. So actually, for a lot of people, if they really just want to, get rich as quickly as possible, retire as quickly as possible, they might be worth walking away from a more prestigious office job and go working selling cars, or some kind of job where you're getting your hands a bit dirty, getting paid double the money. And the bit is, this is a hard pill to swallow. Like when the broker told me that at the time, I was a bit angry at him, but if you look at it hindsight, following his advice, that's what got me into the next property. Like I had to change career to become a broker. And so it's the harsh truth. If people want to make a big difference, they should really consider what they actually do for work. Yeah.
So let's we've probably got time for one more. I'm sure Joe's got 15 questions he can ask. So if we don't, because there's been so many times I wanted to ask questions. But, while we wait for probably there was people asking what a non-bank. It's basically second and third tier lenders. That's the best definition you'd have, JP, for non-bank lenders. Is that what you?
like financial institutions, so not banks. You need to get comfortable with lenders that are not banks. You know, like your Latrobes, your
What
Liberties.
do they do? Okay, yeah, like Pepper. Yeah,
exactly. And because they'll take the other loans with minor buffers, or they'll offer stronger serviceability in some way. So and these days the rate's not much different. As I said, you know, maybe you're at a 3.2, 3.3. You know, you're getting a similar variable rate to that potentially with some of the ADI banks at the moment. For investment anyway. So that's the thing. You just got to be a bit more. You got to be comfortable on the risk appetite. Yeah.
Yeah. Okay. One of the questions here is: has anyone else had such bad tenants? Yeah, me. Yeah. Full strip out, $5,000 worth of damage. Bond was 1,800, whatever it was, something silly. They just trashed the place. But yes, it happens. But that's the joys of being a property investor. It's not all, you know, like actually what I really like about this episode, maybe this will be a nice way to wrap it up, is that you actually put in the hard yards at the beginning, during, and you're still going through the hard yards of managing your entire portfolio, but you saw your end goal. You saw where you wanted to get to, and then you got to it, and then you moved the goalpost. But that's fine. That's a decision you get to make when you actually achieve your goal. But that's what I like about this the most, is that you've actually seen, I want to do this. How can I do this? I need to sacrifice. I don't want to work in this, you know, I don't want to increase my income. I love where I'm at. But also over here on this shoulder is somebody that's saying, well, I want to hit my goals. I want to achieve what I need to. And you've sacrificed, and you've gotten the results from it. So it's that short-term pleasure. Short-term sacrifice for a long-term game. What did everyone think? Throw in the comments if we need to be doing more episodes with awesome investors. Because John, this is actually one of my favorite episodes. And I don't say that. I don't think I've ever said that. Thank you, mate.
I think you said it once or twice. So yeah.
Well,
we've done a lot of these.
Happy days.
But how can people get in touch with you, my man?
Yeah. JP at australianpropertypodcast.com.au. My mobile is 0423 475 336. I'm active on Facebook as well, so people can message me there. Probably one other thing I do want to quickly mention that I think we didn't cover. If someone was starting, like if I was starting in today, what would I do something a little bit differently? I would consider going to houses earlier and renting out room by room. So that's something that's going. If I could go back, that maybe might have been the right move for their second purchase. Instead of going to townhouses, maybe I should have bought a house in that region. And at the time, I think I didn't have enough trust that I was going to be able to manage that properly and whether I was going to actually get tenants. But if I could go back, replay everything, I'd probably have started accumulating houses earlier. And if yield was an issue, I'd be doing something quirky like that. So that's one of the other things I would say that that other people should consider where I went wrong. Yeah.
Okay. And why is that? A little bit, but there's a lot more management involved in that, but cash flow?
The growth would have been dramatically better. I mean, look, the townhouses have doubled for me, but if I'd bought a house, it would have tripled. So that's what I mean. That's the issue. That again, it comes back to buying the best quality asset that's available to you at the time, and in 10 years down the line, you'll be very glad that you bought the better asset. Yeah.
You've opened a rabbit hole, JP, because here people are deals saying, but lenders don't accept room by room leases. That's what too. I mean, I tend to agree that they don't. But and I think it has to be. You have to be so careful when you're doing that. But what's your experience of how you can overcome the not accepting the rents? So
ideally you'd buy it with a tenant already in there, or you'd put a long-term tenant in first or whatever, so you're meeting the obligations of the lender of not lying, and then when that person moves out, then you can go and rent it room by room. Lenders, they won't turn up and say, oh, you can't own the house anymore or anything. You know, as long as you pay the mortgage, they're fine with that. You just need to not outline it that way from the beginning and not do it that way from day dot. But once the current tenants move out, you can. And in terms of using that room by room rental, it should be potentially usable once it's evidenceable on 2 tax returns. So you won't be able to go set it up room by room and then 2 months later buy, but later you will be able to.
Yeah. What about granny flats? What are your thoughts to those? Is this the same thing, just in a different way?
Love
Probably
granny
more of a
flat
capital expenditure.
Yeah, I love those. The only thing with that I find is at the moment it's a bit hard to, like, the purchase price can often be quite high on a lot of those. But yes, if you can afford it, I love that play. Yeah.
So what you could do is buy a block that can have a granny flat, build it up over a number of years, and then put a granny flat on the back, or invest with somebody to be able to help you get the capital to be able to do that type of situation as well. And the only challenge with that is you don't want to overburden yourself with a property that has massive land, and you're paying for that land with a larger loan, which is then dropping your cash flow, and then you don't have the cash flow to support it through the granny flat because the granny flat doesn't exist. But so just don't just buy a 1,800 square meter and be like, oh great, I'll just wait 6 years. I like it. That's awesome. That's some good insights.
So many
scares
questions.
You anymore, JP? You got 3 units in Mount Druitt. Nothing scares you anymore.
Thanks, yeah.
Mount Druitt's significantly gentrified, Joe. I mean, they sort of poked a bit of fun of it with some TV shows, but I think a deal you probably have to reach out to JP to have a conversation about if you want to learn more about that room by room. Otherwise, we'll just have a whole show about rent by room and how lenders treat it. I don't think that's what's being said. But
Is there anything else you wanted? Is there anything else you wanted to talk through, Jonathan? Is there anything else? Any other questions that we kind of wish we asked? Because I'm loving this.
One last thing I'll mention. I still believe in this concept of, and I'll give this credit to Nathan Birch. He talks about this concept of building a foundation portfolio. And I think that you sort of want to get sort of 3 to 5 decent quality assets, and the idea being that you really hold them for the long term, and that's going to build you that equity that you can later use to do whatever you want in life, be that retire, travel, buy fancier places, whatever. So I still believe that. So I think, you want to be, if you're early in your investing, you want to focus on acquiring a couple of good assets, finding a way to hold them long term, and that's going to set you up. Yeah.
There we go.
Yeah, buy the best property that you can afford in the best location at your specification. That's it.
And quality over quantity.
Yes.
No, I think we're good. We promised we were going to keep it a bit shorter, so let's we could go on for another couple of hours, but I think otherwise I really
appreciate 100%. Jonathan, thank you so much for taking the time. This has been an awesome, great story. We've gone from Mount Druitt, the diamond, not even in the rough, diamond in the sand, blue chip diamond. Thank you very much. Let's go buy a property, everyone. See you later.
Thanks for jumping on, JP. Love your work, mate.
Thanks for having me, guys. Really.